Gold prices are facing renewed pressure today as the US dollar continues to strengthen and Treasury yields move higher. These two macro forces are once again shaping the direction of the precious metals market. During the latest trading session, both gold and silver moved lower. The main reason behind this shift appears to be the recent rally in the US dollar index. When the dollar gains strength, gold often struggles. That's because a stronger dollar makes gold more expensive for investors using other currencies. And when that happens, global demand can temporarily weaken. At the same time, rising Treasury yields are adding another layer of pressure on gold. Higher yields mean investors can earn better returns from interest-bearing assets like government bonds. Since gold does not generate interest, some investors shift their capital toward those yield-producing assets. This combination, a stronger dollar and rising bond yields, is one of the most common macroeconomic setups that can weigh on gold prices in the short term. But the situation becomes more interesting when we step back and look at the bigger picture. Despite this recent pressure, gold is still trading near historically high levels. And that tells us something important about the strength of the overall market. Investors are not abandoning gold. Instead, they appear to be reassessing the broader macroeconomic environment. Right now, the market is balancing two powerful forces. On one side, strong economic signals from the United States are supporting the dollar and pushing yields higher. That creates short-term headwinds for gold. But on the other side, global uncertainty continues to support the long-term case for the metal. Inflation concerns, geopolitical tensions, and broader macroeconomic risks are still keeping gold firmly on investors' radar. Another major factor the market is watching closely is the Federal Reserve. If the Fed keeps interest rates higher for longer in order to control inflation, gold could remain under pressure in the near term. Higher real yields tend to reduce the appeal of gold as a store of value. However, if inflation begins to cool and the Federal Reserve starts signaling potential rate cuts later this year, the entire narrative around gold could change very quickly. In that scenario, investors could once again move aggressively into gold. Lower interest rates often weaken the dollar and increase demand for safe haven assets. That is why the current move in gold may look more like a pause in the trend rather than a full reversal. Markets often go through periods like this when macroeconomic signals are mixed. Strong economic data can push gold lower temporarily, while longer-term structural factors continue supporting the market. There is also an important psychological component here. When gold trades near record highs, investors become extremely sensitive to macroeconomic developments. Even small shifts in interest rate expectations or currency movements can create short-term volatility. But volatility does not necessarily mean the broader trend has changed. In fact, many analysts still believe that gold's long-term outlook remains strong. Central bank demand, rising global debt levels, and ongoing geopolitical risks continue to support interest in precious metals. For now, the gold market appears to be entering a period of consolidation. Investors are waiting for clearer signals from inflation data, Federal Reserve policy, and the direction of the US dollar. Those factors will likely determine the next major move in gold. If bond yields continue rising and the dollar stays strong, gold could face additional short-term pressure. But if inflation surprises the market or the Fed signals a shift toward easier monetary policy, gold could quickly regain momentum. And that's exactly why the gold market remains one of the most closely watched assets in global finance. In times of uncertainty, gold almost always returns to the center of attention. And right now, investors around the world are watching very closely to see what happens next.